Hello everyone. Today we're going to be going through the topic of objectives and qualitative characteristics of the conceptual framework. Alright, so first, just to start off, what is the conceptual framework? Okay, so we're going to have conceptual framework. Let's just talk about what it is. Okay, basically it's the concepts that underlie financial reporting. Okay, and so that's just a basic definition, but we're going to get into more specifics here very soon. Framework, basically it ensures consistency across time with respect to accounting standards passed by the FASB. Okay, so the FASB is the Financial Accounting Standards Board, and basically they pass these standards. Okay, and so what happens is that this conceptual framework, it allows the FASB to look at the conceptual framework and say, oh, okay, like what would make sense to pass as a standard for a specific topic that they're looking at. Okay, and it helps us to make sure that over time we're passing standards that basically are consistent and make sense. Okay. Additionally, it provides accountants with the tools to solve issues that they encounter in practice. Okay, so just as an example, like if an accountant is unsure of how to deal with a transaction and there's no standard set by the FASB, the conceptual framework can help the accountant determine the proper treatment of the transaction. Okay, so if an accountant was in like a very specific industry and there was a really weird accounting treatment done in that industry, or there was a weird transaction, then the accountant could look at it and say, oh, okay, like, you know, basically this is what we need to do. This is proper accounting, basically using the conceptual framework as the accountant's guide. Okay, so the FASB has developed a conceptual framework for accounting and has explained the many ideas embodied in the conceptual framework through the issuance of 7 statement of financial accounting concepts. Okay, so these statement of financial accounting concepts, they basically just talk about what is supposed to be in the conceptual framework. Okay, you don't need to know each one of these 7 statements. You basically just need to know that you should know that there's 7 of them. But yeah, that's where the information of the conceptual framework is found. Okay, and then the conceptual framework is divided into basically 3 levels. Okay, and so we're going to go through these 3 levels in just a minute, but let's just preview them first. The first is the objective of the framework. The second level is the qualitative characteristics of accounting information and the elements of the financial statements. And then the third is the assumptions, principles, and cost constraint of the framework. All right, and so that's just an overview of the concept framework. Kind of just guides what we do as accountants and basically tells us, okay, these are the concepts that are going to help us to do accounting and reporting. Okay. So on the second half of the page, the first thing is the objective of the framework, of the conceptual framework. The objective of the conceptual framework. Okay. And basically, according to the FASB, this is literally just straight up copy and paste from the FASB. Okay. They say the objective of general purpose external financial reporting, meaning, you know, the financial statements that we make, the income statement, the balance sheet, everything like that, is to provide information that is useful to present and potential investors and creditors and others in making investment, credit, and other similar resource allocation decisions. Okay, meaning that we're basically just trying to provide decision useful information, right? We're trying to, basically what this means is that we're trying to provide useful information. Okay, mainly to investors and creditors. All right, and this is going to be used by these investors and creditors to make decisions of whether to invest or not. That's a resource allocation decision by an investor or creditor. Okay, now companies fulfill this objective by providing financial statements to external parties such as investors and creditors, like we've kind of talked about a little bit. Okay, next we have the second level of the conceptual framework, which is the qualitative characteristics of accounting information. And we're kind of breaking up the second level a little bit. As you can see at that sort of towards the top of the page there, you have a couple of things there, but we're just going to first go through what is the qualitative characteristics of the accounting information. Forgot that, but make sure you have that there. Okay. And so basically, the characteristics are the characteristics that make accounting information useful to investors and creditors, right? So we just got talking about okay, we want information. Well, what does that look like, right? And this qualitative characteristics are going to help us say this is what useful information looks like. Sorry about that. Basically, so there's three main groups. Okay, so we have three major groups of these qualitative characteristics. Okay, the first is the fundamental qualities. Then we have ingredients of the fundamental qualities, basically like a subcomponent of the fundamental qualities. And then we have this third level of enhancing characteristics. Okay, so let's go ahead and dive into some of these fundamental qualities on the next page here. Okay, so again, we're going through the fundamental qualities. Okay. And we have two of these, okay? And they are relevance and faithful representation. Okay, we have two, and they are relevance and faithful representation. Very important to know the fundamental qualities for, the exams, quizzes, life in general as an accountant, everything, right? You need to know these fundamental qualities. Okay, so the first one, again, is relevance, like we just talked about. And you also need to know, what are they? What do they mean, right? Not just like it's relevance, faithful representation, but what does that mean, right? Okay, relevance means that accounting information capable of making a difference in the decision of a user of the information, okay? Meaning that it's basically right here. It's capable of making a difference, right? It's information capable of making a difference. That's what relevant information is, right? If you were gonna invest in the company, you would want to know the revenues and expenses for the year, right? But you may not care about every single little detail about the company, such as, how many employees they have. It might make a difference, it might not, but that's one that's probably less relevant than their net income, right? Or their revenues or their expenses, right? So we can kind of see some information is more relevant, some is less relevant. Okay, next, like I said, is faithful representation. And so faithful representation means that when the amounts recorded represent the transactions and events as they actually happen. Okay? Meaning that what we're actually showing in what we're recording, meaning in the financial statements, right? So financial statements, what we're showing in our financial statements, do they reflect reality, right? Are they actually showing what we did during the year? That's basically faithful representation. Okay. So those are the two fundamental qualities. Now we're going to move on to the ingredients. Ingredients of the fundamental qualities. Ingredients of the fundamental qualities, just about there. Okay. And basically, these are the components that make up relevance and faithful representation, like we just talked about. We just talked about faithful representation. We talked about relevance. Well, we know what they are in a general sense, but what are the things that make up those components? Okay. First, we have something known as predictive value. Okay. And again, and like you can see, there's three of each. There's three components within each fundamental quality of relevance and then faithful representation. Okay. So first, within relevance, we're looking at first, we have predictive value. Basically, predictive value means that when accounting information allows the user to form an expectation about how the company will perform in the future, right? So if the accounting information allows you to predict the stock price or the cash flows in the future, it has predictive value. Okay. Then we have something known as confirmatory value. Confirmatory value. And this means that when the accounting information allows the user to determine if his expectation was incorrect or correct. Okay. Excuse me. Basically, you can look at your prediction, you can look at your expectation, and you can, okay, yes, I was right, no, I was wrong. Okay, that would be confirmatory value. Next, we have something known as materiality. Okay? And materiality is accounting information is material if its omission or misstatement could influence a user's decision. Okay, so if we misstate something or we don't even include it in the financial statements, we omit it, right? So it's omission. then that is material information if it affects the user's decision. Okay. So that's all the components of relevance. Now we'll move on to faithful representation. Again, we have 3 components. And the first one is known as completeness. Completeness just means that when the reported financial information includes all the details necessary for faithful representation, right? So we've included everything that we need to actually show what took place. Okay. Next, we have neutrality, which means that there's an absence of bias when selecting what information to display in the financial statements. Okay. So companies are not allowed to pick and choose what information they show. If a certain group wants one information, another group wants different information, it doesn't matter. Companies cannot basically look at that and say, oh, well, this group wants this information, we're going to show that. No, they have to show, they cannot have bias when they're picking what information they're going to show. Okay. And finally, free from error is the last ingredient of faithful representation. Free from error basically just means that there's no mathematical errors, there's no inaccuracies, right? It's free from error. It's kind of explanatory in the name, but there's no inaccuracies in the information is basically what that's getting at. Okay? Now we just have one last part for this lesson, which is just going to go through the enhancing characteristics. Okay? Enhancing characteristics. So this is the enhancing qualitative characteristics of accounting information. Okay? Basically, these are the characteristics that enhance the quality of financial information displayed in the financial statements. Okay? It just makes the information better. Okay? And there's 4 of these. All right? And again, like with the ingredients of the fundamental qualities, like with the fundamental qualities, you need to know what these 4 are. And then you also need to know what the actual basically definitions. You know, do you need to know like word for word definitions? No, you know, that's not really reasonable, but you do need to at least be like, okay, this is the general idea of what this is. Okay. So the first one is something called comparability. Okay. And so what that means is that's when accounting information allows users to identify similarities and differences between 2 sets of economic facts. Okay, when they can identify similarities and differences between 2 sets of economic facts. That's comparability. Okay, then we have something called consistency, which is sort of, it goes along with comparability, but it's a little bit different. Okay, consistency is when a single company uses the same accounting methodologies from period to period. Right, they're using the same methodologies across time, basically. Okay, but so that's for one company across time. But for comparability, we're generally looking at one time period, and we're looking at 2 separate companies, and we want to be able to compare, okay, what happened with Apple versus what happened with Amazon, or whatever 2 companies you want to compare. And that's what comparability allows us to do, because it tells us, okay, you guys have to use similar methods of depreciation or inventory methods or whatever it might be, so that way we can compare across you guys and get a picture of what's going on, basically. Okay. Next is verifiability. Okay. So verifiability, information is verifiable if 2 professionals independently arrive at the same value for a transaction. Okay, so if 2 professionals were going to do something like, you know, determine the value of an asset, liability or something, and they both come to the same conclusion, yes, this accounts receivable is worth $20, and then the other guy says, oh, it's worth $20. Okay, that means the information is verifiable. Okay, to left, the next one is timeliness. This one's relatively straightforward. It just means that the accounting information is provided in time to be useful to decision makers, right? We want to provide it sooner rather than later, and that's why there's a lot of stringent requirements for companies to get information out fast, especially if they're, you know, publicly traded and under the purview of the SEC. Okay. The last thing we have, the last enhancing characteristic would be understandability. Understandability. And basically, what this means is it's when accounting information allows those who are reasonably informed with respect to accounting and business to see the significance of the information. Okay, meaning that these people have some idea of what's going on in accounting and some idea of what's going on in business. They understand the financial statements. They see the significance of the information saying, okay, here's my revenues, here's my expenses, here's my net income. Someone with reasonable understanding of those topics would say, okay, that's very important because that means that all these things are going to be true about the company in the future, or, this is my prediction in the past, it came true, or whatever, right? So it's not just anyone, right? But it's someone who's reasonably informed. Okay, they can see the significance, they can understand the information, and basically glean. They can determine what they want to do from there. Okay, and they glean value from it. So that's the end of this lesson, and I hope that helped.